Hello trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at the euro today as it continues its slide on some really interesting statements from ECB policymakers and where they're leaving projections for euro area interest rates relative to the Fed's projections here in the US, currently causing some downside for euro and some strengthening for US dollar. We're going to talk a lot about different policymakers and the differential between interest rates in just a second, but let's start with the price action in the Forex market itself. Excuse me. Euro has gone from above 109 all the way to below 108. And as you can see in recent trading, around 107.5, really seeing some considerable downside, especially in the last 10 or so trading days, as you saw the huge rally in euro coming off of the March FOMC, which everybody took as a relatively dovish event. Fed Chair Powell confirming once again that rates in the U.S. likely to come lower this year. The question becomes when, and then the following day and now 2 weeks since that March FOMC event, we've seen ECB policymakers say, oh, well, actually our rates might come lower a little bit sooner than the U.S. More on that in a second. But yeah, some pretty crazy price action as this market is now getting to what's really been the downside support level, if you will, of this range for the last handful of months, right around 107. This is a market that, yes, has been as low as 105 in the last year of trading. And if you expand that to the last couple of years, they've broken parity. But 107 has held in recent months. It'll be really interesting to see if this euro continues to slide through not only 108, but on through 107. More on that to come in the next few trading days, I'm sure. We'll see either the bounce back or the move on to lower and some new territory for the last couple of months. But let's take a look at what's been going on in the interest rate realm, because a lot of the ECB versus Fed, the euro area interest rates versus the US, has a lot to do with this price action, and likely no coincidence that over the last couple of days we've gotten two different statements from two different ECB policymakers, but both pointing in the same direction. The first from the French ECB member, Francois Villeroy, saying that policymakers are looking for moderate interest rate cuts to come as soon as this spring. And he, in his statement, said that this is regardless of the Fed's actions. I think a lot of people have been in this trend of, oh, well, the Fed in the U.S. led in interest rates to the upside a couple of years ago as inflation started to spiral out of control. Inflation's back in control, and so now the U.S. and the Fed are going to lead to the downside. Well, you see here that the most recent probabilities from Fed funds futures pricing out there for the June Fed meeting, it's only about a 60-40 and even less than that probability that rates are lower versus unchanged in June. This is the June 12th meeting, and so pretty much the last semblance of a spring rate cut that you could get from the Fed, and it's close to 50-50. Like I say, it's exactly 58-42, erring slightly in the direction of a potential rate cut. But when you have ECB policymakers like Mr. Villeroy saying that, you know, we're looking at moderate rate cuts as soon as spring, and in the U.S. it's only 50-50 for June, tells you that the ECB might be cutting sooner than the Fed. And then you have the statement that also came from Robert Holtzman, whereby he said that Europe could cut interest rates before the U.S. flat out. And again, this leaves the euro and the euro area in a little bit of a vulnerable position, because when you look at global interest rates and keeping in mind that forex prices, a lot of the demand for one currency versus another has to do with where you can get the highest interest rate. And you see that, okay, euro area at 4.5%, that's pretty good. It's not as good as the U.S. at 5.5%. And then you put into this dynamic that the ECB might be looking at cutting from 4.5% down to maybe 4.25% or 4 even before the U.S. even moves their interest rates. That's going to widen that differential and potentially create more demand for the U.S. dollar versus the euro, and potentially hit those euro prices even harder. And so a lot to keep in mind here, and I'm sure there'll be more words from ECB members and Fed members in the coming days and weeks leading up to the next interest rate decision from both central banks. But something that you can also watch on almost a weekly basis is inflation rates from these two regions. And obviously, Euro area has a number of countries that will report inflation: Germany, France, Italy. You can watch all of those individually. But the Euro area inflation rate is already nearing 2%. And this is where the ECB members are coming from when they say, hey, we're not necessarily watching the U.S. We're watching our own metrics to look at cutting rates sooner rather than later, because their fear is, well, inflation is a backward-looking metric. And what I mean by that is it's letting you know the change in price levels of goods and services looking at the last 30 days to the last year, and measuring that. And so what can happen is when you're using backward-looking metrics and a current, present-minded interest rate, is if you're waiting for the 2% inflation target to hit, and right now it's at 2.4, 2.5, 2.6%, depending on what metric you're looking at, close to 2% in the euro area. Let's just say it's close to it, and you're not cutting interest rates, and then all of a sudden inflation hits 2%. Oh, okay, we'll cut interest rates now, and then next month it's down to 1% or even lower. And you can see as recently as 2020 and the start of 2021, inflation rates were at 0% or pretty close to 0%, which is not what you want. That's a sign of a struggling economy. And so the ECB members are trying to balance this backward-looking metric and the present-minded interest rate, and not necessarily let inflation and employment and their economic data slip too far before they cut rates. And now, oh man, we waited too long, and now we really have to cut rates down to close to 0% because our economy is struggling. So it's a nimble dance that the ECB policymakers have to do here, and we'll see if they are able to strike that balance. And that's why, again, their inflation's already pretty close to 2%, and they're looking at cuts maybe sooner than the U.S., because then you have the U.S. and Fed Chair Powell, who also in the last couple of days has come out and said that, the Fed can be a little more confident about inflation coming down before cutting rates, because the U.S. employment and GDP and all of those numbers are looking really strong. And so almost the exact opposite idea as those ECB members is Powell saying, yeah, we can actually be a little bit pickier on inflation coming down to closer to 2%, because our employment to start 2024 and GDP numbers have been really strong. So we're not so much worried about an economic downturn as parts in the euro area, as we are worried about inflation coming down. And so the U.S. might have interest rates higher for longer than the ECB, and that might have to have a continued effect here on this euro versus the dollar. It's having an effect right now as prices move below 108. Of course, continue to watch this data, because this data can change on a dime and move in the opposite direction. But for the time being, U.S. strength continues, and the euro seeing further downside below 108.